Hey everyone, welcome to Market Insights. I'm Brian Christopher. Today I'm joined by my friend and colleague Ian King. Ian's the editor of Automatic Fortunes and Crypto Profit Trader here at Banyan Hill. Ian, how are you?
Doing great, Brian. What's happening?
Oh, just enjoying the moves of this market. It's pretty amazing. Also, before Ian and I chat, remember to subscribe to this channel and click on the bell to receive an alert whenever we post something, and leave a comment, and then we'll know what you want to hear about and what we screwed up on, or maybe what we did right. But moving on, Ian, as I mentioned, we've seen some amazing movement in the market lately. Basically, from September 2nd to the 8th, in just that 3-day period, the market, the Nasdaq 100 fell about 11%. And I went back and looked at the numbers. It was the fourth largest 3-day drop really since the dot-com bubble burst. So I'm talking more than 18 years ago. And I guess that gets people scared. On Wednesday we saw a big comeback in the market. It was up several hundred points. But and then with the Nasdaq 100, I'm talking more specifically about tech stocks. Do you have some thoughts that listeners could enjoy and use with respect to how to think about tech stocks going forward, with this volatility that we're seeing?
Sure. I think pullbacks are pretty healthy. And people might disagree with me on this, but the last couple of months, we've pretty much been lulled to sleep. Everyone's gotten complacent. The market has gone up every day. Every time you turn on CNBC, it seems like the market was up 1%, right? Or 2%. And finally, we're introducing some volatility back to the market. And unfortunately, the old saying is, you take the escalator up and the elevator down. So when people start selling, you do have these sharp pullbacks. But I think this is really just par for the course. Eventually, the market will find some footing. And I do think that we will resume this rally into year end and next year. And, one of the reasons is stocks aren't really that expensive. I mean, you could look at Apple and Microsoft, which are both companies that are sitting on a ton of cash. This is not .com, right? And they earn a lot of money. They've got great earnings, and they're trading somewhere between 30 and 40 times earnings, which is a little higher than they've traded over the last 5 years. But you also have to consider where are investors going to put their money. The Treasury is below 1%. The U.S. 10-year notes below 1%. Junk bonds are down below 3%. So if you're managing institutional money and you have to allocate, especially for these big pension funds that need to make 7-8% a year, where are you going to put your money? You have to put it into the stock market. You have to take some risk to get those kind of returns. So that's why I think there will be a continuous bid in this market, or at least one of the reasons why, I think. What do you think about that?
Well, I think, and what you say about, during the dot-com boom, if you look at that same Nasdaq 100 index, which today is trading about 30, 40 times, back then we were talking 80, 90, 100 times, for the companies that actually had earnings, and the big dogs today have both earnings and cash. So I tend to agree with what you're saying. We also know that there's a lot of money in the system, right? Like there's just a large money supply that we're seeing today, and I think
let's pull up the chart. Now that you mentioned it.
Yeah,
you got a chart for us?
Yes. Yeah. Well, we've got the money market balances, which are still near all-time highs, even though they have pulled back about 300-400 billion from their highest level, at the end of May. But at their current level, which is about 4.5 trillion, we're still 900. We still have money market balances of $900 billion more than we had at the beginning of March.
Yeah, it's pretty incredible. I think there's two factors behind that. One, in March, you had 30% of people 60 or over liquidate their entire stock portfolio. So they went and raised cash, unfortunately, close to the bottom. And the number two factor is we've had, $3 trillion worth of government stimulus, whether it be the stimulus checks or the Paycheck Protection Program. And one other factor is that for months, where were you going to spend your money? There was no travel. People weren't going on cruises. You couldn't eat at restaurants in most states. So you have these money markets that have just really been accumulating as people had nowhere to spend it. And one way you could have done is put your money into the stock market, but we're starting to see that money market chart come down a little bit as the economy starts to reopen. I think it will sharply drop even more when people really reinvest back in the stock market, buy the stocks they sold at the bottom in March. And unfortunately, and also, when they spend it into the economy, when things really start to fully reopen this year.
Hey, and Ian, you also had some other thoughts. I talked about how the market's been moving. You had some thoughts about volatility as well, didn't you?
Yeah. So for me, what I care about is not so much the news, but rather how are people positioned when the news comes out, right? So you always hear this term, buy the rumor, sell the news. And one of the ways we can look at it is by looking into the options market and the volatility markets specifically, and see whether or not institutional investors are hedged. And we can judge that by the prices they're willing to pay for insurance. And I have this chart that I want to share with viewers right now. It's the VIX term structure. And what this basically does is it tells us how willing option traders, and specifically hedge funds and institutional investors, are how willing are they to pay up for insurance for an event that's going to happen in the future. And when the term structure is steep, like we're seeing right now, it's the steepest it's been in over 4 years, it means that they're very worried about an event in the future, in the next couple of months, and they are hedged. So they basically have on a big, maybe it could be a put position on their portfolio to hedge their underlying portfolio of stocks. Now, what's key here is we know what these events are, right? The events that people are worried about are another wave of coronavirus, or what happens around the presidential election, the uncertainty. Is there going to be a smooth transition of presidential power, or is there going to be a contested election? We don't know that right now. And market makers, institutional investors, hedge funds are hedging that risk right now. And if both of these, coronavirus, a new coronavirus wave, and the presidential election turn out to be non-events, I see a path for this market really to rip higher because of the positioning that's happening right now, where institutional investors are bearish. They're worried about the future. And if these events turn out positive, you're going to see this market really take off. And I think that could turn us into some of a melt-up scenario as we head into year end.
Right. That basically that bearishness is already reflected in prices. And therefore, as you say, if it's a non-event, I mean, it could even be better than we worry about, and we could see the market move higher.
Exactly. I think we could have a couple of hiccups this fall. Like, I don't necessarily think that the selling that we saw the other day has fully subsided, and we're going to bounce and go up to new highs. I mean, that's one scenario, but I wouldn't be surprised if sometime in October we have another scenario like we had in early September. So my guess is the market tries to find some footing, stabilizes, trades in a range until we start to see the outcome of these two events, the next wave of coronavirus and the potential, uncertainty around the presidential election. But, I think in the long run, you really have to be bullish on stocks. Like I said earlier, with treasury rates so low, staying low, and where are people going to put their money? They're going to put it into growth stocks, especially with rates that are going to be this low, and the Fed will be on hold really for the next 3 to 5 years is what they're saying now. So
that's right. Well, that's great advice. That's a great place to wrap it up. Thank you for your insights. I think people can learn a lot from what we talked about this week. So have a good weekend, Ian. Thanks for joining me.
Thanks, Brian. Great to see you. And you have a great weekend as well.
All right. Thank you. And you guys remember, like the video, subscribe, leave a comment. Thank you very much. We'll see you next time.